Good evening, ladies and gentlemen. This is June Collier. Welcome to Stock Investing for Complete Beginners. Some of the early people that got in early tonight, I was just asking the question if they felt like I was going too slow or too fast with this information. And I'm really trying to pace it so that I don't give you too much in 1 week and then you get bombarded. But at the same time, I don't want you to be bored either. So hopefully, my speed is right on time. If it's not, please let me know if I'm going too fast or if I'm going too slow. But tonight, we're going to cover some more information about how to look at a stock and determine, if this is a stock that you want to purchase. Last week, we went over, thank you, Miss Denise. Last week, we went over fundamental analysis, how to look at the numbers of a company. And that was very important. I hope you guys got a lot of value out of that because that was a huge teaching. That's like the fundamentals. You got to learn the fundamentals of picking out a great company. And we're going to continue to talk about that here tonight. But before we do that, my man Microsoft, man, my boy Microsoft ran again, and it ran hard. And so hopefully you guys have downloaded some of those apps that I talked about, CNBC, Yahoo Finance, and hopefully you're looking at those apps and looking at the news. And so if you know anything about Microsoft, Microsoft invested very heavily in this organization. I'm gonna call them an organization, not a company, but this organization called OpenAI. And they are the developers of ChatGPT. And if you remember, about artificial intelligence like we know it today took off about a year ago. It was almost probably a year ago now. It's been a year. And they hit the scene in November of last year and just took off. And now AI is everywhere. And so ChatGPT was the first one that really launched it in the way that they launched it. And so the CEO and one of the co-founders of OpenAI, they got the board for OpenAI. They got in a disagreement or whatever, or how things should be done, and they voted them out. So they voted out the CEO and they voted out one of the co-founders of OpenAI on Friday, I believe it was, Friday afternoon. Well, between Friday afternoon and Monday, Microsoft hired the now ex-CEO and the ex-co-founder of OpenAI. Now, Microsoft has made a huge investment into OpenAI. So they're playing both sides. So Microsoft is deeply embedded with OpenAI. They're probably the largest contributor right now to OpenAI financially. But they also just hired the ex-CEO and the ex-co-founder of OpenAI over the weekend. That's big. That's a big move. That's a major play that has happened in the artificial intelligence arena. And so that's one of the reasons why you saw Microsoft stock jump today on that particular news. And again, if you are embedded with the stock like I am with Microsoft, you should be, anytime news comes out, you should be on top of it, figuring out what's going on. And so I want to share that with you real quick, and then we'll jump straight into our training here tonight. Where was it? Boom. Oh, no, that ain't it. Boom. Okay. So OpenAI ousted CEO Sam Altman. He was the CEO of OpenAI. And then there was the co-founder of OpenAI that also went over to Microsoft. All right. And so this is pretty huge because Microsoft has the best of both worlds. If something happens to OpenAI, doesn't work out or whatever, Microsoft has the brainchild of OpenAI that's working now at Microsoft. But Microsoft also still has a relationship with OpenAI. And so when that news sort of hit the scene, the stock, Microsoft just took off today. It just took off, right? And so, yeah, it was pretty major. Okay, it was pretty major. Something that's big going on behind the scenes. So just a big win for Microsoft. Again, Microsoft invested $13 billion with OpenAI. So the relationship with OpenAI is not broken between OpenAI and Microsoft, but OpenAI, their board members decided to get rid of Altman and one of the co-founders, and so Microsoft scooped them up, and so Microsoft now has the best of both worlds. So that was huge news that happened with Microsoft. And if you were looking at the Microsoft stock today, we'll go over to finance.yahoo and take a look at Microsoft. You will see that Microsoft, at some point, at one point, Microsoft was up $8, but it was up $7.59 today at 377.44. Remember, Microsoft broke an all-time high last week. And here it is again. It broke another all-time high, because if we look at the 52-week range, 378.87, we know that all-time high was that today. Yep, it broke another all-time. It keeps breaking all-time highs right now. So this is the reason why I wouldn't be buying it, because it's at the very top. It's never been this high before. And so there's a stronger chance of it going down than it is to continue to go up. You know, whatever goes up must come down, right? At least come down somewhat. And so for this reason, I am telling people don't necessarily buy Microsoft right now, because we don't know when it's going to turn around. And I don't want you buying at 378 and then it turns around and pulls back to 350, because it could do that. It's done that in the past. It could do that. All right. And you would just have to wait. Now, even if you bought it now, it wouldn't be a bad buy, especially if you're going to hold the stock, because personally, I believe that Microsoft in the next 3 to 4 years, if they don't do a stock split, we'll talk about that here tonight. If they don't do a stock split, I believe Microsoft could be a $500 company, $500 a share company. So even if you did buy it today and it pulled back and it went back to 350 over the next several years, you still have a great purchase price of Microsoft. That's just my personal belief. All right. What are the chances of Microsoft splitting stocks? Typically, a company does that when it wants to attract more investors, and we'll talk about stock splits here tonight. But I don't think at this price, at 377, I don't think Microsoft needs to split. Probably getting around $500, $600, $700 a share. Typically, I think at that point they may do a split, but maybe we'll have an opportunity to take a look at how often they've done splits in the past. Okay, but let's get into the rest of the work, because I know this is interesting, but we've got some more stuff that we want to cover here tonight. All right, so the first thing I want to do is I want to go over our quiz from week 3, just to make sure that we're all on the same page. If there's any questions about the quiz, now is the time to ask. So I think we had only 10 questions, so we're going to go through these 10 questions really quick. Which of the following financial statements provides a snapshot of a company's financial position at a specific point in time? And so this is sort of the overall financial snapshot. That would be considered the balance sheet. The balance sheet, right? Remember, we got the assets, liabilities, and equity on the balance sheet. That's what that answer is, the balance sheet. Number 2, which of the following financial statements summarizes a company's revenue, expenses, and profits over a specific period of time. That would be your income statement, okay? Your income. When we look at the revenue, the expenses that go out, and the profits over a specific period of time, okay? Because remember, revenue and cash flow kind of are similar, but revenue is I made $1 million this year. I spent $500,000 this year. I've got a profit of $500,000, okay? Which of the following financial statement shows how cash has moved in and out of a company during a specific time? This is the cash flow statement, okay? So cash flow and income are very similar, but they're very different as well. What is the term for a company's total sales? This is the sales that they did for the whole year. And we know that the total sales is the sales revenue, okay? It'd be sales revenue. Also, I like to, and I interchanged this last week, but I want to clear it up because I said top line revenue, right? The top line growth. Top line means, you know, what the company brought in, the sales revenue, what's the growth. And when we look at top line growth, what that basically means is I'm comparing the sales revenue from 2020 to 2021 to 2022 to 2023. So I'm doing a comparison of sales revenue from one year to the next. That shows me top line revenue growth. And I don't know if I was clear on that during our training last week, but top line revenue growth is not technically sales revenue. It is the comparison of sales revenue from one year to the next, all right? What is the term for a company's assets minus its liabilities, okay? What is the term for a company's assets minus its liabilities? And this is equity. And that makes sense, right? So if we look at those of you that own a home and we say, well, how much equity do you have in your home? Does that mean that you paid the home off? No, it just means that what's the value of your home minus the liability, minus whatever you have left to pay on the home gives you equity. So like I said, it's very similar to our personal lives when we start looking at stocks, okay? Your asset, which is the value of your home, minus what you owe on the home, tells you what the equity is. So for a company, it's its assets minus its liability, that is the equity, all right? That should make a lot of sense. What is the term for a company's profit after all expenses have been paid? What is the term for a company's profit after all expenses have been paid? That's going to be called net income or net loss. So basically, and when we look at net income, I like to call that the bottom line revenue. I want to look at bottom line revenue, okay? And again, it's a comparison of top line revenue minus all of the expenses. I want to look at the bottom line revenue to see, yeah, you're growing in sales every year, but when I look at the bottom, you're spending more money than you're making, than you're bringing in. And so that's the net income or loss. What is the term for a company's debt and obligations? Obviously, that's liabilities. What is the term for a company's leftover cash after it has paid for its operating expenses and invested in new assets? That's free cash flow. True or false? Net income or loss is a measure of a company's profit after all expenses have been paid. Okay, that is true. True or false? Top line revenue growth is the measure of a company's ability to increase its sales. And that's also true. Yeah, that's also true. All right. All right, so those are the quizzes, are the answers to the quiz. If there are questions on that, now, speak now, or hold your peace. So you can drop something in the chat, or you can drop a question, and we're going to go straight into our training here tonight. All right, I don't get anything. So let's get into the training because we got a lot to cover here tonight. Make sure you got a pen and pad because I got some stuff to cover tonight. All right. All right. So I'm going to actually go directly to Yahoo Finance. I actually printed this out. I printed this document out. So I'm going to be looking at it, but this is the document here. Let me just kind of show you real quick what the document is. I printed out a PDF, and what we're going to do is we're going to go to Yahoo Finance, and I'm going to break down each one of these numbers, what they are, what they mean, so that when you're looking at a stock, you know how to analyze these different numbers. I definitely recommend that you print this out. Again, it will be in week 4 folder, and I will upload it here to the chat here right now. So I'm going to upload it to the chat as well so that you can have access to it. And again, if you're using a tablet, you may not necessarily see that, but it's okay because it is also in week 4 folder. All right, so let's do this. I'm going to hop over to Yahoo Finance, and the way that we get there is we type in finance.yahoo.com. Okay. So the first thing that I want to do, we're now in the financial section of Yahoo, not the sports section. We're in the financial section of Yahoo. The first thing that we're going to do is we're going to type in the company ticker symbol. And if we don't know what the company's ticker symbol is, we'll just type in the name of the company. And we'll type that right up here in the search bar. So we're going to use Apple because that's what I use in the example here. And let me just type in Apple, A-P-P-L-E, and you'll see that the ticker symbol AAPL will come up. So even if you don't know the ticker symbol for a company, just type in the company's name and you'll find the ticker symbol. So we're going to click on this. Now, what I will tell you is that the handout that you have to print, this is from 2020. So this was about 3 years ago when I did this class. I did do Apple. So you're going to see a price difference, a dramatic price difference in Apple, but everything else is pretty much the same, okay? Because at the time, Apple did do a 5-for-1 stock split. So they did a 5-for-1 stock split. So when you look at the sheet, it's going to say Apple is at $425. But Apple did a 5-for-1 stock split. And here's where it's at now. Okay. All right. So the first thing that we're going to actually take a look at is we're going to take a look at the company itself. And you're going to see the name of the company here, Apple. And then to the right of it, you're going to see the ticker symbol. And we see the ticker symbol AAPL, 4-letter ticker symbol. Somebody tell me what a 4-letter ticker symbol typically represents. Somebody in the chat, just type in the chat, 4-letter ticker symbol. What does that typically represent? Boom. There we go. Carry. NASDAQ. Okay. So remember, I told you that a NASDAQ stock is typically going to be four ticker symbols. Okay. So Carrie got that right. And here's how you know that she got it right. Because as we look right below Apple, we'll see the stock index and you'll see the NASDAQ. Okay. So this is a stock that's carried on the NASDAQ. Now, to the right of that, you're going to see that the price of the stock is in US dollars. All of the stocks that we're going to look at are in US dollars. However, if you start looking at international stocks, the currency may be in a different currency. But this just lets you know that the currency is US dollar. Now, right below that, we're going to see the current price of the stock. So right now, the current price of the stock is $191.45. Okay. You're going to see if it's up for the day, this is going to be green, just like you see here. You see the green here? This is green. Even this bar up here that's green, that lets you know that this stock is up for the day. I'm sorry, Carrie. I gotta, you know what? my apologies, Carrie. Carrie is a he. Okay, my apologies, Carrie. So what this does is this shows us that the stock is up $1.76 today. Okay, $1.76, which is a 0.93% percentage increase. Okay. Now, if we were looking at this during the trading hour, right below this, it would tell you as of 12:01 or 12:05 or whatever. So it would, because the price of the stock changes. It would tell you as of, but this says at close at 4 p.m. Okay. Now, that being said, when does the stock market open and what time does it close? Type it in the chat if you know what time does the stock market open and what time does it close. Type in the chat. What time does the stock market open and what time does it close? Desiree says 9 a.m. James says 9. Then someone said 9:30. Someone said 7. All right. Somebody said 8:30. Oh, let me be more specific. Eastern Standard Time. Eastern Standard Time. Okay. Eastern Standard Time. So the stock market opens at 9:30 a.m. Eastern Standard Time. It closes at 4 p.m. Eastern Standard Time. It's important for you to know when the market opens and when it closes. It opens at 9:30 a.m. Eastern Standard Time, closes at 4 p.m. Eastern Standard Time. It opens Monday through Friday. There will be times where it will be closed during the holidays. So this Thursday, the market will not be open this Thursday. Okay? All right. So now there's something that happens, however, because over here to the right, you'll see something that says after hours. Well, not everybody can trade after hours. If you've got a brokerage account that allows you to trade after hours, you can. I've never traded after hours. I do have a brokerage account that allows me to trade after hours, but after hours trading is much different than trading during normal session. Here's why. There's less people trading during after hours. And so a lot of the things that you would expect to happen may not necessarily happen in after hours trading. But here's what you're going to see. After hours trading is going to run from 4 until about 8 o'clock, right? And there's some pre-trading that happens. I believe it starts at, I don't know, I think, don't give me the line. I won't tell a lie here tonight. I can't remember exactly when the pre-trading opens, but you've got to have a special account. You've got to have your account approved for you to trade before the rest of the market is really trading. Okay. Before the rest of the market is really trading. All right. So I'll look that up before we leave here tonight. But what we're going to be talking about is we're going to be talking about when the majority of the people are trading, which is 9:30 to 4 o'clock. Okay. Do I think there's an advantage to trade after the hours or before hours? I don't think that there's that much of an advantage, especially for a beginner. You're probably just not going to do that. All right. All right. So now, right below this, we're going to see that there's these tabs across the top here. Summary, company insights, chart, all of these things here. We're going to be looking at the summary. And the summary is going to give us an overall view of this stock. So the first thing we're going to look at is the previous close. So the previous close, it closed at 189.69. Well, when was the last time it was open? Well, today is Monday. So this previous close would have been Friday, last Friday. It closed at 189.69. Now, what did it open at today? Today, it opened at 189.89. Well, wait, June. It closed Friday at 189.69. How did it open up at 189.89? Doesn't it open at the same place that it closed? And this is something that most new investors, they think should happen. They think that, well, if it closed at 189.69, tomorrow it's going to open at the same place that it closed. It doesn't work that way. It doesn't work that way. Sometimes it opens at the same place, but oftentimes it doesn't. And when you see that, when you see the difference between where it closed at the previous day to where it opened at, that's called a gap. Y'all write that down because I didn't put that in your notes. The difference between the previous close and the open, the difference is called the gap. And when people say the stock gapped up or the stock gapped down, you'll see that frequently when, let's just say that a company had some bad news, but they waited till the end of the day. And let's just say Apple had some bad news, they closed at 189, and then they released the news after the market was closed. Well, the next day, the stock might gap down to 150, depending on how bad the news is. So you didn't even have a chance to get out of the stock. Let's say you had the stock at 189, you got 100 shares of it, 200 shares of it, and some bad news comes out, and you think, well, I'm gonna get out first thing in the morning. Well, you might want to think about that before you do that, because you don't know how far it's going to gap down. Okay, so a stock can gap. You will see gaps in a stock, Okay, and when we start looking at charts, daily charts, you'll be able to see that stocks don't necessarily start the next day where they ended the day before. That's called gapping. The stock will gap. Okay. All right. Next is our bid and our ask. Now, a lot of people get confused on this, but I want to talk to you about this so that you are clear on what's going on. So when you are bidding, here's what I want you to think about. I want you to think about you being at an auction and you're bidding on something. Let's say you're at a car auction and you're bidding on a car. So you raising your hand every time. You're raising your hand, right? A bidder is the buyer. So when we look at the bid, this is what the buyer is paying. So here we see that the buyer is at this particular point in time, the buyer is willing to buy at 191.55. And there are 1,200 shares of this stock of buyers that will buy at 191.55. So that's what this number represents. 191.55 represents the largest amount that a buyer is willing to buy. And there's 1,200 shares of this particular stock that buyers are willing to buy at 191.55. Okay. Now, if we have buyers, we must have sellers. So as a seller is asking, and you're going to always see that the ask price is either going to be equal to the bid or more than the bid price. So I'm sorry. I think I did that wrong. The bid, let me just make sure that I got that right. I think I just told you guys wrong. Hold on. Because what I'm getting ready to say, if I said that doesn't make any sense to me. If I said that. Stock exchange currency. No, I did say that right. I said that right. Okay. They ask. This is what the sellers are asking. Okay. All right. So the sellers are asking for 191.65. That's what they're asking. And there are 3,200 shares out there that sellers are willing to share or willing to sell at this price. Okay. So if I'm willing to buy at 191.55, you're willing to sell at 191.65, there's a 10 cents difference here. There's a 10 cents difference. And so what ends up happening, this 10 cents difference is called the spread. Write that down, the spread. The difference between the ask and the bid is the spread. And there's something else that's not in your notes, but there's something called market makers. Market makers. These are the people that ensure that there's liquidity in the market. And let me explain what I just said, because that's probably a lot. And like I said, I need you guys to take notes tonight. And if you got questions, please type them in the chat. So the buyers are bidding $191.55. They think that I shouldn't pay no more than $191.55 for Apple. Those that own Apple says, well, I don't want to sell Apple for less than $191.65. The difference there is a 10 cents difference. So here's what's going to happen. In that 10 cents difference, either the bidder is going to pay the $191.65, or the seller is going to sell the $191.55. But the difference is the 10 cents. Okay. So here's what ends up happening. The buyer is going to buy the stock at $191.65. The seller is going to sell the stock at $191.55. That means that there's a 10 cents difference there. The 10 cents difference goes to the market maker. Okay. This is the middle guy. If you didn't know it, there's a middleman. There's always a middleman. Okay. In the stock market, we call the middleman the market maker. Okay. And you can do some research on this, but there's the market maker. Now, the market maker exists for liquidity. And here's what I mean by liquidity. If you go in and says, okay, I'm going to buy the stock for $191.65, I want 100 shares, you put in your order and immediately the order is taken. And you immediately got 100 shares at $191.65. Well, that's because the market maker has bought the shares at $191.55 and sold the shares to you for $191.65. Okay. So the market maker takes the risk of owning these shares of stock so that there's liquidity in the market. So when somebody wants to buy, they can buy. When somebody wants to sell, they can sell. A lot of people used to ask me, well, June, well, how does a person know that I want to buy some stock? Or, you know, you own this stock, but how do you know that there's 3,200 people out here that want to sell it, or 1,200 people that want to buy? You don't. The market maker is the one that buys these shares of stock. And when you're actually buying or selling, you're not selling necessarily directly to June. When June buys Microsoft, somebody is selling Microsoft, but they're not selling directly to me. They're selling to the market maker. The market maker has the shares, and when I get ready to buy, the market maker sells me their shares. When I get ready to sell, the market maker takes they take my shares and they sell my shares. And the difference is called the spread. And so you want to always keep an eye on the spread, because you don't want your spread to be too far apart. So for example, you wouldn't want the bid to be $191.55 and the ask to be $192.55. That's $1 there. So you're already in the negative. If you buy at $1 and there's $1 spread, you're already in the negative $1. I hope that makes sense. I'm trying to make it make sense. Okay. So the bid and the ask, you want to have, and if you do your research and you study stocks long enough, you'll hear people talk about, I want a tight bid and ask. What that means is, I want a tight bid where, maybe there's only a nickel or 10 cent spread there. You start getting into, bigger than 10 cents, you start getting to 15, 20, 25 cents. That's an expensive price to pay. So we're looking at a spread that is either zero, which you're probably never going to see because the market maker doesn't make any money on that, or, a nickel to 10 cents. Okay. So that's the difference that you'll see. So if you're selling, this is what you're asking, but you're probably going to get this if you're selling. You're going to get 191.55. If you're buying, you're asking for 191.55, but you're probably going to end up paying 191.65 if you're buying. Okay. All right, let me just check the chat here real quick because that was a mouthful to cover. All right. So Melissa says, so the market maker goes in blind, not knowing if they will sell. Well, the market maker knows that shares of this company are going to sell because we're going to get down here and we're going to talk about volume and average volume. For example, 58 million shares of this stock trades every day. So the market maker knows that somebody's buying and somebody's selling, right? They're smart enough because a lot of times they will see the orders that are already there. So when we start talking about limit orders, and you can set your trading account to buy when this stock reaches this price, automatically buy. So while you're out working, your account could buy stock because it reached a certain price that you set. The market makers can see that. So they know when a stock gets down to a certain level, there's people that have already set buy orders or sell orders. So they're using all of this information. So don't feel bad for the market maker because the market maker is going to make money. Don't feel bad for the market maker. Barbara says, is the market maker the broker like Moo or Schwab? It can be. Typically, you're not going to see an individual as a market maker because it's too much money that they're going to need to buy shares. So yes, the market maker can be financial brokerages, institutions like that you're actually buying and selling your shares through. Okay. All right. Good questions. All right. So now let's go down below this. The day's range. This is the range of where the stock is traded for the day. So Apple is traded as low as 189.88 and as high as 191.90. That is the range of the stock. Then when we look at the 52-week range, we look at 124.17. It's traded as low as 124.17 within the last 12 months and as high as 198.23. So now here's what we're going to do. We're going to take a look. Where is the stock in comparison to the 52-week range? Is it trading close to the all-time high for the last 52 weeks, or is it trading closer to the all-time low? Somebody tell me. Where's it trading? It's trading closer to the high, okay? And so oftentimes what I'm doing, and this is just me, I'm going to teach you guys as we go along. If I say, well, what's a good price for Apple? Well, right now, Apple is trading at 191.45. The all-time high is 198.23. And so I like to go here to this calculator. And I told you guys we're getting down to the point of really starting to learn. Okay. So if I say, go back here to Apple, and I'm sorry, that's not Apple. So Apple is right now at 191.45. I know that it went to 198.23. So I'm going to bring my calculator over here. And I'm going to say 191.65. I'm sorry, 45. That's the price it is right now. But it's been as high as $198.23. Okay. That's only 3.5% from its all-time high. So it is very close to its all-time high. Okay. I need everybody to understand that. So Microsoft is Apple is 3.5% away from its all-time high. So I may not necessarily buy this stock because it's 3.5% away from its all-time high. But if I'm looking for a deal, I'm looking for a pullback. A pullback can be anywhere from 10 to 15%. So if Microsoft is trading, if the all-time high is 198.23, and I keep saying Microsoft, Apple. So I'm going to pull out my calculator, and I hope you guys are following me with this. Pull out my calculator. One of the things I'm going to look at is I'm going to say, I want to get this stock at a 15% discount. So I'm going to take 198.23 times 15%. I get to take $29.73 off. So $29.73. So I'm going to take the 198 minus $29.73. And if Apple dropped to about 168.50, that's a 15% pullback. I'm probably going to go ahead and pull the trigger on that. And this is what happened with Microsoft when it went to 311. Okay. So Stephanie says, why did I use 15%? Because your average pullback is going to be 10 to 15%. That's a pullback. And all stocks are going to experience pullbacks from time to time. Okay. So let me show you that as well. Great question. I'm going to back up the question. A pullback is really, I think, 15 to 20%. But let's what is the percentage for a pullback? Okay. So a pullback is 5 to 10%. Okay. So I was wrong on that. I don't know why I said pullback was 15 to 20%, but the pullback is 5 to 10%. So it's going to be a very short-term pullback. It's a dip. All right. So let's just say if I use 10% on that, if I use 10% on the Apple, 10% would be $19, almost $20. So if Apple pulled back to 170, 171, that would be a pullback, and that would indicate that the stock is down 10%. I may want to jump in at 10%. Okay. We got the pullback, and then what's the other one? It's going to hit me. The other one is 15%. Okay. Correction. Thank you, Barbara. Thank you. I had a brain fart there. Thank you, Barbara. So the pullback is 5 to 10%. So let's look at, oh, here it is. It says pullback and correction. So let's look. Let's just take a look here. A pullback is 5 to 10%. Okay. A correction is going to be between 10 to 20%. And it tells you how long it can last. So we're looking for, in this case, I'm either going to look for a pullback, or if you really want to get a deep discount, we're looking for a correction. Okay. And then you got a bear market. A bear market is when the market drops 20% or more. Okay. So the one thing that I know about Microsoft is that Microsoft will do a pullback a couple of times a year, and you may see a correction in Microsoft once, maybe twice a year. Okay. Once, maybe twice a year in Microsoft, you'll see a correction. But a pullback, you'll see a pullback a little bit more frequently. So what that means is, once I find the stock that I'm interested in, I'm going to go look at the stock, the price of the stock, and if I think that the stock is running high like Microsoft is right now, I would probably use a 10% pullback on Microsoft to determine what my next entry price is going to be. So if Microsoft is trading right now at 377, I know that 10% will be $37 off of this price. So if Microsoft pulled back to 340, then that would indicate an entry price for me to get into Microsoft. So, and I won't even use this number. I'm not going to use this number. I'm going to use this all-time high. So the all-time high was 378.87. I'm going to take 10% off of that 378, which is about $38. I'm going to take that, subtract it. If I subtract, $38 from this, then that's going to tell me where I might enter into this particular trade. But I don't use just that. There are other signals that I'm going to use, but this is just a rough estimate of where Microsoft would have to pull back in order for me to get in. So to answer your question, when should you get in Microsoft? Right now, and this number could change. This number is subject to change as Microsoft increases in price, but Microsoft's 52-week range was $378.87. So we're going to take 378.87 and subtract that by $37.88. That would be 10%. So if Microsoft pulled back to 340.99, 341, we're just gonna call it an even 341. If Microsoft pulled back to 341, I tell you to go ahead and buy. Okay, that's a good example. Now, if you're looking for a great deal, if you're looking for a super sale, then you would maybe use 15%. Okay, and that 15% would be your entry number. Now, this is just one thing that you would do. I gotta wait till next week to show you the full part of it. Okay, but I don't want to get too far off track here. Hopefully, everybody understands what I just suggested. How many shares would you recommend? The number of shares is based on a couple of different factors. How much money you got, how much money is in your total portfolio. I'm never going to invest more than 10 to 15% of my total portfolio in any one particular stock. And there's a class that I got on that as well that you'll be getting, but that will be several weeks from now. Okay. But I'm never going to invest more than 10% of my total portfolio. So if you only had $100,000, then the most that I would invest in one individual stock is going to be about $10,000. Okay, because that would represent 10% of the $100,000 that I have. Because you don't want to put all your eggs in one basket. 10 to 15% is all that you want to go in that one particular stock. Okay. So you could set the price to buy at 341. Yes. We're jumping ahead of ourselves, but yes, when you set what's called a limit order, and we'll cover this later on, you can tell your brokerage company, when Microsoft drops to 341, I want to buy 10 shares. I want to buy however many shares that you've got that you want to buy. So you can tell it that, you can set it and forget it and don't even think about it. And then one day you'll get a bing, bing. You just bought 10 shares of Microsoft because it dropped to your price. All right. All right. Let me get back on track. Good questions though. All right. So that's our 52-week range. Let me get back here on Apple. All right. Now, here's the thing that you got to pay attention to: volume. So volume is how many shares of this stock are traded every day. So today, there were 44 million shares of Apple that was traded today. 44 million. Normally, there's 58 million shares traded each and every day. So the volume is down today. Not as many shares traded today. And a lot of investors are going to look at volume. So when I see volume and I'm seeing that it's below, and you look at whatever the percentage is, I want to know why are people not selling? Are they holding because there's good news on Apple? What's going on? So usually that's going to be an indicator. Typically when some bad news comes out, a lot of volume is going to be, it's going to spike because people are trying to sell. And then people are trying to buy at a discount. When there's really good news, a lot of good news in the market, there's going to be a lot of volume. Okay. Let's take a look at Microsoft and see what the volume is today. So this is a good example. So we're looking at Microsoft. We know what just happened. Microsoft just hired the CEO and the co-founder of OpenAI. Microsoft average volume is typically 23 million shares. This is the average volume. But today, it was double that amount. It was 52 million shares because of the information that came out today, which was considered good news, because Microsoft is really the leader right now in AI. And they just hired 2 guys from OpenAI, ChatGPT. That was huge news. So, and then you saw the stock go up 2% today, $7.59. So see how volume can tell you a lot about what's going on with that particular stock. If the volume is twice as much as what it averages, we know that something happened that day. Some news came out, something happened. And in this case, it was something positive. I hope everybody sees that. This is very, very important. Each one of these lines are extremely important for you to watch. Okay. Is this the reason AI is up today? It could be. Yes. Yes. Okay. All right. So now, market cap. Let me go back to Apple because we're talking about Apple here. Market cap, $2.978 trillion. Market cap. This is what we call a mega cap stock. So do you guys remember what market cap was? We covered that in week number 1. Market capitalization. Okay. You had large cap, small cap. You had all those micro cap stocks. And this is a mega cap stock. And remember what capitalization was. Capitalization is the price of the stock, 191 times the number of outstanding shares. So if there's, I don't know how many shares, if there's, 2 million shares, you multiply 2 million times 191, that's going to give you the market cap. Okay. All right. Let's take a look at beta. Right. So beta tells you the volatility of the stock. And here's what the volatility of it measures the volatility of the stock compared to the market. So volatility is basically risk. A volatile stock means that stock is going to swing all over the place. It's going to swing high, it's going to swing low, it's going to swing. Now, some people love volatility because you can make a lot of money in a short period of time with volatility. These are typically your day traders. Your day traders love volatility because they want to be in and out and they want to make some money that day. So they're looking for highly volatile stocks. If you're a retiree, you may not necessarily want to be in a volatile stock. So the beta tells you how volatile the stock is. So a beta of 1 or less is a relatively smooth stock. It's not, it's relatively smooth. If it's 1, if the market goes up 5% for the day and the beta on that stock is 1, the stock is going to go up 5% that day, typically. Okay. But if the beta is 2 and the market goes up 5%, you can expect that stock to go up 10%. This is why day traders love high beta, because they can, if they're right about the market, they can make a lot of money. Okay. So that's what the beta is. It's just, it's comparing to the market, the overall market. It tells you how risky or how less risky that stock is. Okay. So let's take a look at Microsoft. I didn't even look at the beta. So you see with a Microsoft's beta is an 88. It's less than 1. So it's pretty smooth. We're not going to see a whole bunch of jumping up and down, even though Microsoft's a very strong stock. but the beta is a relatively safe stock. And if you guys remember, I told you I don't like losing money. And so another reason why I like Microsoft is because I don't have to worry about waking up one morning and Microsoft and dropped $50, or waking up one morning and Microsoft and went up $50. You're probably not going to see that. What you're going to see Microsoft do is what it just did. It moved 2%, 3%. If you see Microsoft moving 5% that day, I mean, that's a hell of a day. But typically, you're going to see it move, 2%, 1%, 3% for the day. Okay. The worst beta, I think I was doing some research, and the S&P 500 talked about the beta being, I can't remember what it was. It was a crazy number. It was 10, 15, something like that. It was crazy. But we want to, depending on your investment style, you want a beta under 1. If you're day trading, if you're doing that type of stuff, you're probably happy with betas of 1.5 and 2, because you're looking for that stock to move during the day, swing back and forth. Okay. All right, let's take a look at PE ratio. PE ratio basically is your price to earnings ratio. Okay. Now, this one is a good one as well. I want to spend a little bit of time talking about your PE ratio. Okay. Your price to earnings ratio is going to take the last 12 months of earnings, and then it's going to divide that by the number of shares, and it's going to tell you per share, this is the earnings per share. Okay. I'm sorry, that's EPS. This is the price to the earnings. Okay. So basically, you're willing to pay, in this case, you're willing to pay $36 for $1 of earnings. That's what that basically means. You're willing to pay $36 for $1 of earnings. Why would you pay $36 for $1 of earnings? Because you're projecting that Microsoft is going to grow in the future. So I'm okay with paying the $36 for $1 of earnings, because I'm projecting that Microsoft's going to be $500 in the next 3 or 4 years per share. Okay. And so what you've got to look at when you start looking at, is this PE ratio, is this a good PE ratio? What you want to do is you want to compare it to what it's done in the past, as well as compare it with PE ratios of its competitors. Okay. So for example, tech stocks are going to have higher PE ratios than, say, an energy stock. Okay. Tech stocks have more room for growth, and you're going to see a higher PE ratio. In fact, let's go look at an energy stock and put the two side by side. So I'm going to go look at, let's just say, Duke Energy. And we're going to look at the Duke Energy PE ratio. Okay. Now, Duke Energy, it's not going to, I mean, there's not new technology. It could be a good stock, but it's just not going to have a lot of growth. I mean, it's just a steady, good stock, probably pays good dividends, which it does. It pays really good dividends, but it's a steady stock. And it's not just going to just grow through the roof 5 years from now. 5 years from now, Duke Energy is going to be $89. I mean, that's just, maybe $90 or $92, something like that. Okay. But when you look at the PE ratio, the PE ratio is $19. So you're willing to spend $19 for every $1 of earnings. Okay. Notice that the beta is 46. So even the beta, again, this is a steady stock. It pays some great dividends. So this is a stock for somebody that's retired. You want steady income. You want an income stock. You want to be safe. This is that stock. It doesn't have a whole lot of volatility in it. The PE ratio is low. It pays a good dividend. Ain't nothing wrong with this stock, okay? But I want to compare the PE ratio of Duke Energy with the PE ratio of Microsoft. We know Microsoft is going to, well, we don't know this, but I'm going to tell you that Microsoft going to the moon. Look at it. This is Microsoft, okay? That's why the PE ratio is 36. If we look at Duke Energy, you'll see that it doesn't look like what Microsoft looks like, okay? But nothing wrong with Duke. I don't want you guys thinking that I'm picking on Duke. I'm just showing you the difference. You need to understand the difference and notice that Duke is not in the same industry as a Microsoft. Now, what would I compare Microsoft to? Maybe I would compare the PE ratio to an Apple or Google. So we go to Apple. We're now looking at Apple. The PE ratio for Apple is 31. The PE ratio for Microsoft is 36. If I go and look at Google, let's type in Google. Google is probably going to be very close to that. PE ratio for Google is 26. Okay, so everybody see that. So now you understand the price to earnings ratio. It depends on the projected growth, the future growth of the company. If the projected growth of this company is that this stock, Apple, Google could be a $200 stock in the next couple of years. So it has that potential of doubling itself. Microsoft has proven itself. It did 57% return just last year. So the people are willing to pay more for a dollar's earning in that stock because it is growing. We're looking at a stock like Duke Energy is not going to do that. Okay. So that's the price earnings. Now, earnings per share. This is the one that we want to also look at. Earnings per share says how much earnings is this stock going to make? Like for every share that you have, the stock should earn $6.13. Now, how do I know if the EPS is a good number? Well, what I want to do is I want to look at the history of the EPS. Okay, so let's look at Microsoft because I love Microsoft. So we see that earnings per share, for every share, there's about $10.32 of earnings. Now, is that good or bad? Well, you don't know by just looking at it this way. So what you have to do is you have to go do some research. And here's what I did. I just did some research and said, I'm looking for Microsoft's earnings per share over the last couple of years. So here's what it's going to show me. It's showing me that in 2021, the earnings per share was $8.05. In 2022, the earnings went to $9.65. In 2023, the earnings went to $9.68. Now, we're not done with 2023, but it says the 12-month period of 2023, the earnings is $10.32. So we can see that the company, the earnings are growing. So when I look at a 1032 earnings, then I'm happy because just 2 years ago, the earnings was $8. Now it's $10. So I see that the earnings are growing over time. So you just can't look at this number by itself in a vacuum. You've got to go back and look at what were the earnings the year before, the year before that, the year before that. What were the earnings? Okay. Now, a great way to see that is if you go over here and you start looking at earnings. This is your earnings here. And you can see that your earnings are growing. The blue is what the market expects, and the green is what they actually did. Okay. And we'll talk about that when we get to technical analysis, but that just kind of shows you what their earnings are. And we can see that their earnings are growing quarter after quarter. So this is quarterly. These are quarterly earnings. We can come down here and you can see annual earnings. So we can see in The blue represents the earnings. In 2020, we got 44 billion in earnings. In 2021, we got 61 billion in earnings. In 2022, we got 72 billion in earnings. So we see that earnings is growing. We can see that earnings is growing. So there's multiple places that you can go to see that. I just went and did a research to see what the numbers were for the earnings per share. Okay. Hopefully everybody got me on that. I'm hoping that this is good to you. All right. Now, earnings date. So we know that the stock reports earnings every quarter. So when is the next earnings coming out? The next earnings for Microsoft is coming out between January 22nd and January 26th. They'll usually figure it out as we get closer, but between those dates, that's when the next earnings announcement is. Now, most people don't like buying the stock during or leading up to earnings because it could be good, it could be bad. Your stock could go anywhere. So you really want to know when is the next earnings announcement, because you don't want to buy the stock the day before earnings because you got a 50-50 shot of what's going to happen to the stock. Okay. So Melissa says, should you be concerned that the earnings is so much less than the projected, or is it as long as it's moving forward is good? So here's what happens. Great question. So based on the company, the market will set what they think their earnings for that. They will give an estimate of what the earnings for that company should be. So that's what you're seeing with the estimate. And then you'll see the actual. So in this example, they estimated on quarter Q4 2022, they estimated that the earnings would be $2.29 for that quarter. The results was $2.32. So they beat earnings by 3 cents. Then the next quarter, they said that they expected the earnings to be $2.23. Well, when they made their announcement, the earnings was $2.45. So beating earnings is always good. Doesn't always mean that the stock's going to go up, however, because Google did the exact opposite here recently. Google had earnings and they beat their earnings, but the market didn't like the fact that Google didn't really talk about its AI. And so the market temporarily beat Google up. And I hate to say I said so, but I'm gonna go get my receipts. I told everybody on Facebook about Google, and I said, this is what I said. I'm gonna go over here because this is a good place to show this. Google beat earnings. So we're gonna go down here to Google here. Let's see. When was it? When was it? When was it? That was Microsoft. Google. So Google, hold on, let me go back to when it dropped. I post this stuff because I don't want you guys thinking that, okay, so Google, this is a great example. On October 25th, that was a little 5 days from a month ago. That was 25 days ago, okay? Google was down 10%. It dropped 10%. We can see it right here. It dropped 10%. It had just did its earnings announcement and it beat earnings. It actually beat earnings, but the market made it drop 10%. And the reason why they made it drop 10% is because they didn't like the fact that Google did not report anything or much about AI, its AI capabilities and technology. Now, if you understand Google, 80% of Google's revenue comes from advertising. They reported that there's more watch hours on YouTube, which Google owns, than Netflix. So I'm like, why are we beating Google up for not being as good at AI as Microsoft when that's not what Google does? Google sells advertising, and it's beating everybody in advertising. But the market unfairly put Google against Microsoft, and the stock dropped 10% in one day. You don't typically have that, not for a good company. And so what you need to understand is that the market can be emotional sometimes. It can be emotional. And I said, I'm going to get some of Google. This was October 25th. Google was trading at 126. I think Google actually dropped down to 125, 124, because the next day it dropped another 2%. It was getting into the correction territory, which was crazy to me. 126. If we look at Google today, 137. I called it, because you got to understand what's going on. And sometimes the market gets it wrong. And when you see a pullback like that, now's the time to hop in, and it won't be long before that stock increases. Because if a stock makes money, and I told you guys this last week, I always look at top line revenue growth. If a stock is making more money than it made the year before, and the year before, and the year before, when it has a pullback like that, you don't second guess it, because the stock is already proven to be a moneymaker. You don't second guess. You just go get you some. And that was an example, okay? And so what we want to do is we want to keep our eye on the earnings date, and we typically don't want to buy the stock at earnings, because what if I had bought Google before the earnings and it dropped 10%? That's a lot. So you wait until after the earnings announcement and then determine if you want to get into the stock or not. I need y'all to write that one down. That's something that you need to make sure, okay? All right? So if you want to know about that, go to my timeline, because I posted it the day that it happened. So this ain't no after effect. I posted it the day that it happened. I said I pulled the trigger. I went ahead and bought me some Google, right? And then I broke down the revenue. I broke down Google's revenue and why I thought that it was unfair that they judged Google incorrectly. And that was on October 26th. And here we are, November 20th, and you see where Google is today. It's $11 higher today than when I called it a couple of weeks ago, okay? So this stuff that I'm teaching you actually works if you understand what we're looking at. So we see here with Apple, or with Google, their earnings date is going to be January 31st, between January 31st and February 5th. And then right below that is going to tell you if the stock pays out any dividends. In this case, Google doesn't pay any dividends. So that's going to be non-applicable. But if we go over here to Microsoft and we look at Microsoft, you will see that Microsoft pays dividend. So Microsoft pays a 0.81% dividend yield. Not the best and sexiest dividend yield, but I love the company. So the company is making money hand over hand, and so I'm not too concerned about the dividend yield, okay? We look at a company like, let's go back to Duke Energy. Again, depending on what you want as an investor, if you are retired and you're looking for some dividends, then you might want to have some Duke, because Duke pays 4%, 4.5% dividend yield. Whereas we look at an Apple is paying 0.5% dividend yield. But the reason why it's not paying as much in dividend yield is because it's putting more of its money back into the growth of the company. And that's why you'll see the stock grow faster than a stock like Duke Energy. So again, you've got to determine who you are as an investor to determine what stock's a good stock for you to be in and what stock's a bad stock. For somebody, I can't imagine who, but for somebody, Microsoft might not be the best stock. maybe Microsoft would not be the best stock for somebody that's retired and they're depending on a dividend. Microsoft may not necessarily be the best stock, okay, for them. But for everybody else, you need to be getting you some Microsoft. All right. All right. So there's our dividend yield, the ex-dividend date. All this means is that in order for you to get this dividend, you must own the stock by November 10th. Okay. Now, November 10th is already passed. So if you bought some Microsoft or Apple today, if you bought Apple today, when it paid out dividends in next, you would not get any dividends, even though you owned it, because you didn't own it by November 10th. You got to own the stock by November 10th in order to get the next dividend payout. That's what ex-dividend date means. And then down here, the 1-year target, this is what the analysts say the 1-year target is. This don't mean nothing to me. None of this doesn't mean a whole lot to me, okay? What's important is the information that we went over, okay? That's what's important, all right? Now, there's a lot that I just covered, but the handout that you have, it covers every last one of these. And you need to understand why they are important. You need to understand if I'm looking at what's my entry to get into a stock, if I'm looking for a pullback, I'm going to take 10% of this number, and then maybe that's going to be my number. If I'm looking for a correction, I'm going to take 15% of this number, 15 to 20% of this number for a correction, and I'll get in at that price, okay? That's one key indicator, okay? Never buy at an all-time high. You also know that if the volume is either higher than normal or lower than normal, we need to check out what's going on with the stock, because it means that people are interested in the stock. They're either interested in buying the stock or they're interested in selling the stock more so than they normally are, okay? We look at our beta. Our beta is going to tell us the risk of this stock. Is it very, what's the word I was looking for? Volatile? Is this stock very volatile? Which means that if the market is up 5%, is the stock up the same amount as the market? Is it more than the market? Is it less than the market? So if I'm day trading, I'm going to probably want more volatile stocks. I want more volatility if I'm day trading. I want to wake up, if I'm day trading, I want to wake up and buy a stock today at $20 and sell it the same day at $30. That's a volatile stock, right? I want a stock like that if I'm day trading. But if I'm an investor and I'm investing long-term, I may not necessarily want that kind of stock. That's all over the place, okay? Price to earnings ratio, we know that depends on the industry that is in. If it's a growth industry, if it's a technology industry, the price to earnings ratio is going to be higher. So we see that 31. But if it's in a stock like a utility, the price to earnings ratio might be 15. 12 to 15 is one of those stable economies, stable companies. The earnings per share, we want to see earnings per share growing. This number by itself means nothing. I got to go back and look at, is it beating earnings year over year over year? One way of doing that real quick is to scroll down and just look and see, are these blue bars getting bigger and bigger year over year? If so, we know that the earnings per share is good because it's growing, okay? And that's it, right? I'm gonna stop here. I'm gonna roll out the other piece that I was gonna train tonight. I'm gonna roll that out till next week, because I told you I don't want to get you guys overwhelmed. There's a lot of numbers to look at tonight. And I just wanted to stay here tonight and look at these numbers, okay? I wanted to look at these numbers tonight because there's a lot to look at, and you may need to go back and review. So what I'm gonna do right now is I'm gonna stop my share right now, and I'm going to take any questions that we've got. All right. And again, I hope that my pace is a good pace. I could run through a lot more than what we're running through, but that would mean that you may not necessarily get all what you need to get for the week. Okay. Because this is enough. So I'm going to advise everyone to go ahead and print that out. It's about 10 pages. Put it in your notebook and then go through it and then start looking at different companies that you're interested in and looking at their numbers. We're going to look at their financials. We're going to look at the top line revenue growth, the bottom line revenue growth. We want to see if they got any debt. We want to see how much cash they got, how much debt they got. We want to see what their free cash flow is. Then we want to go here and we want to start looking at these numbers to determine if this is a potential company that I'm willing to invest in. And so hopefully now that you have all of this information, you're starting to gather and figure out, how do I look at a company and analyze whether that company is a good company for me to be a part of. So we know that a pullback is 5 to 10%. A correction is going to be somewhere between 10 to 20%. And then a bear market is 20% or more. Okay, so we're definitely not, I won't say we're definitely not, but we're not in a bear market right now. We probably should be, but we're not. We're not in a bear market, but there are stocks that may have pullbacks. And when I saw Google do 10% in one day, it dropped 10% in one day. That was because I knew that was a pullback right there. There's a pullback right there in one day. And usually it takes several days for a company to get to the number where it's a pullback. But Google got to the pullback number in one day. And if you understand that, and you understand the company, and you understand why it pulled back, it makes sense for you to invest. I didn't even hesitate to invest in Google on that because it just made sense. Okay. So Melissa says, I have the previous printouts. Should I trash those and update the ones for this class? Has a lot changed? No, most of everything is the same. In fact, if you print this out, you're going to see the talking points, and the talking points are going to say 2020 because Apple was trading at $4.25 before the split in 2020. Apple did a split in 2020, and before the split, it was trading at $4.25. So the information is the same. And that's the beautiful thing. There's no need. I mean, fundamental analysis is fundamental analysis. It doesn't change. It's the same. It's the same. It's the same. You're going to look at the same thing, whether it's 10 years from now, 20 years ago, it's the same thing. So it doesn't change. So you don't have to kill any trees. Now, I don't know if I gave you this in our last class, because I didn't spend a lot of time on this like I did tonight. And the only reason I spent time on this tonight is because each class that I do, I'm learning the class and I'm learning what I should be doing. For those of you who don't know, that this class used to be a 6-week class, right? And I think I turned it into 12 weeks, right? Because I was cramming it down people's throats and it was too much. So we spread it out a little bit. And so even with us not meeting on Christmas and not meeting on New Year's, it still makes it a 10-week course instead of a 6-week course. Okay. All right. Blackwell says the pace is great. All right. Any questions on anything that we've covered here tonight, even some things that we may not have covered? You guys asked some great questions. I just want to make sure that I cover all that you need. Any questions? Man, we got a lot of folks on here tonight. Glad to see all of y'all on. All right. I don't see any hand raised. Here's Barbara. Why do they use points and not dollars? Why do they use points and not dollars? I don't understand the question, Barbara. Can you be a little bit more descriptive on that? Oh, okay, like the stock is down 20 points. I don't know. I don't know. That's just part of the language, I guess. Yeah, I guess that's just part of the language. If I say the stock is down 20 points, so here's the thing, and that's a great question, Barbara. Here's what I want people to understand. So, like, if I look at, let's just say you take a stock like, let's take a stock like AutoZone. Okay. If I take a stock like AutoZone, AutoZone was up $22 today. That seems like a lot, $22, but that's less than 1%, less than 1%. Okay. And so I always like to talk in percentages. I'm up 1%, I'm up 10%, because the price of the stock, it doesn't matter. I like to look at percentages. And let me tell you guys this. That was a great question, Barbara, because it's going to lead me into something else. When wealthy people talk in percentages, they don't talk in a dollar amount. They talk in a percentage. Let me give you an example. Many years ago, I had a vending business. I had vending machines. And so people would laugh and say, I ain't no money in vending machines. You're just getting nickels and dimes and this and that. But I literally could go to the store and buy a case of Coke, the bottles, for 50, 55 cents. I could put those bottled Cokes in my vending machine, and later that day, somebody would buy that Coke that I just paid 55 cents for. They would buy it for $2, $2.50. So my return was over 200%. And water, oh my good, I love selling water in my vending machine, because I could get a big case of water, and the bottle of water cost me 16 cents, 20 cents a bottle, and I'm selling that for $2. So while you see me getting out quarters and nickels and dollars, the reality is that vending machine is giving me 100, 200% profit. So a 200%, if you can make 200% profit, what that means is if I put 10,000 in, I'm gonna get 20, 30,000 out. Obviously, in my vending machine, I'm not putting that much in. I might put $150 in, but I'm now getting $300 out. So we talk in percentages, because we understand that if I can get 50, 60, 100% on a regular basis, all I got to do is put more money on it. So we talk in percentages. Okay. Just a comment. This type of information should be a part of high school curriculum. This is what we need to know. Yeah, it should be. It should be. I find myself cussing every time I pay $2.69 for a 20-ounce soda, but I don't want to buy a case, so I shut up. Yeah, I have a hard time buying drinks, because I had a vending machine, and because I know the convenience that people spend on a vending machine. But when you think about it, it's ridiculous. I mean, snacks, drinks, it's ridiculous. It's ridiculous. All right. All right. So that's all that we got. I'm not going to hold you guys any longer. I want to wish each and every one of you a happy Thanksgiving. We'll be back here next Monday for our class. And next Monday, we're going to start talking about technical analysis. So technical analysis, when we're going to start looking at the charts, we're going to start looking at the bars. We're going to start looking at oscillating stuff and all that good stuff, okay? And so be ready. Bring your thinking caps next week. Take what I shared with you here tonight, watch the replay, go print out everything, make sure that you get a clear understanding. If you don't, write your questions down and bring it to class next week, okay? Until then, God bless, take care, and we'll see you guys next Monday. Good night, everyone.